how to navigate the recession of 2022. That's what we're going to be talking about in today's stock market brief. I'm back from an amazing vacation. When I arrived, guess what was at my door? The plaque from YouTube for getting to 100,000 subscribers. So I just want to say thank you for all the continued support, for all my active daily viewers and the ones that are new here too as well. We appreciate you coming by. I also want to thank my patrons. I currently have 823 patrons that pay $9 a month to get some benefits and be part of the community as well. Also want to thank Interactive Brokers for partnering with me. They have some really cool free educational stuff. If you haven't checked them out, the link is in the description. You can see their podcast as well as blog articles. Here's some of the podcast recent ones, but some of the blog articles that I like were written by the chief strategist from IBKR, Steve, and you may have heard him in various podcasts too. He is just a wealth of knowledge. Let's get into today's episode of how to navigate this market. So first and foremost, let's talk about where we are and where I think that we can potentially go. And in order to do that, I want to look at the yields, okay? The first and foremost, this is the yields up here, and where we're looking at, 3 months, 7 year, 2 year, 5 year, 3 year, 20, and so forth. And you can see we've been talking about way back over here where they started compressing and getting tight. Now they're getting into inversion, okay? The big one standing out to me is that 3 month, how it's just been completely going absolutely vertical. Now, what does this mean? Well, it means that we're starting to get yield curve inversions. This isn't good, right? Yield curve inversions are never good. It's been an indicator, especially the 10 and 2 year, it's been a great indicator for leading up to a recession. Now, we've already had 2 negative quarters of GDP growth, which is technically a recession, but it seems to me that politicians across the board are trying to redefine what a recession actually is. Well, the 10 and 2 year has inverted and is continuing to go deeper into inversion and hold there. Not a good sign. It's at minus 30 basis points, so it is negative. The 10 year and 3 month, this is more of a Fed staple right here, and you can see this has been falling off a cliff here, heading to inversion. Thought that it might hit there last week, but we're at now 4 basis points, so we're not far off from inversion. I would imagine that that's going to be inverting here very shortly. To add to that, we had recent 75 basis point rate hike. Powell signaling that we have more hikes coming. Why? Well, because we need to tame inflation. Inflation got to 9.1%. Now people are calling for, hey, this is the peak of inflation. Okay, but even if it's the peak, inflation is still going to be running hot. Consensus for the next report, which should be coming out August 10th, is at 8.9%. So we'll see if it comes in at consensus, under consensus, or above consensus. Regardless or not, it is still a high number and it's putting pressure on consumers and just the overall economy. We had ISM come out today, and it was much kind of a nothing burger in the markets. It was down slightly, but it was above consensus. When you take a deeper look into the reports, you can look at new orders. New orders came in below 50. It's at 48. It was a subtle decline right here. So this is showing contraction in ISM manufacturing new orders. And if you look at manufacturing and employment, this was actually a nice uptick, but it is still below 50, so it is showing contraction there too as well. So overall, the ISM is still above 50. However, you can see that it has been declining. We haven't seen, this low of a reading for quite some time. All right, now what do we have on the docket going forward? This week we have JOLTS coming out. We have some more ISM non-manufacturing PMI data. And we also have some more data around the globe too taking place in some major areas. We have balance of trade, non-farm payrolls, and unemployment. The big one's going to be coming on, I believe, the 10th, where we get the CPI data, okay? But a lot of eyes are kind of turning towards the headlines right now about Nancy Pelosi to visit Taiwan. China's, basically making these threats. You shouldn't be doing this, but now they're saying that they're going to be going regardless. So we'll see what comes from that. I guarantee you there's going to be a lot of market participants, a lot of people watching to see what kind of news comes from that. Now, I want to show you something very interesting here because we just went over a lot of data, but I want to tie things together a little bit. The tech rally rolls on undeterred by bad earnings. Pay attention to the date. That was January 22nd of 2001 reported by Barron's. Why am I showing you this? This was during a time where we started getting bad earnings despite, the record move in the dot-com bubble. Now, if I take a look back here and we look at the yield curve where we stand today, if you look back to the left of the chart, we haven't been this inverted since the dot-com bubble. And during that time, you can see this is the Fed fund rate. Greenspan was actually raising rates, right? And then the market kind of broke a little bit. And then they started to flatten rates. And then we started to pivot, right? We started to lower rates very, very quickly, very, very fast. And what took place in the markets? This all ties back into a lot of people trying to determine this Fed pivot that is going to be really good for the markets, right? As soon as the Fed pivots, it's good to go. There is something interesting that I want people to pay attention to. Not saying that this is going to play out the same way, but understand here was a pivot also taking place. So the market kept on continuing to just, well, burst. What was the case there? Why was that the case? Well, over here, right over here, it says that the tech rally rolls on, undeterred by bad earnings. This was January 22nd, okay? January 22nd, 2001 was right about here. So this is Barron's reporting right here, that article. And, we got a little bit of a move up, like right over here, we saw a little bit of a bump up, but you can still see there was a significant amount of downside to come. And that is simply because despite the pivot, we had revenues and profits of many of these high growth companies during the bubble decelerating. And what we're seeing right now is we have the Fed tightening, we have yield curves inverting, all right? And on top of all of that, Jerome Powell is tightening into a slowdown. What do I mean? Well, take a look here. This is the S&P 500, right? This is reporting year-over-year earnings growth of 6% for Q2 as of now, okay? Q2 of 2022, which is the lowest growth since Q4 2020. So if you look down here, you can see these sectors that are reporting, it's being lagged by financials, consumer discretionary, and communication services as of now. Right here is the energy. Go figure. Energy has been a huge mover, and we're starting to see good earnings. Go figure. But this, goes with the whole peak inflation thing. If inflation is going to start subsiding but still remain high, this could be very well a peak also in earnings for energy companies. Okay, so this is very similar to me to this period in 2000. Why? Well, because we had the Fed raising rates, okay? We had the Fed raising rates, then they started to obviously pivot. However, they were raising rates into when we started seeing earnings decelerate. And that is kind of what we're seeing very similarly right now in the markets. If I break this down to, okay, so what does this mean for, individual investing? Where should we look? This right here is a really good picture of, following various different assets using an intermarket perspective. If we take a look at commodities versus bonds, utilities versus S&P 500, these are relative strength lines, and then the correlation between the two. All right, I've showed this before. This is one that I posted on Twitter May 14th. So when bonds begin to outperform CRB, which is commodities, XLU, which is a defensive sector, starts outperforming the SPY on a relative basis. So basically what that's saying is when the bonds, boom, outperform the commodities, meaning that this line goes down, we should see this line continue to move up. However, what we found interesting during this post was utilities is outperforming the SPY, as you can see right here, at the same time that the CRB index is outperforming bonds. Now, you can see it going up here, and this was going up. This doesn't happen all too frequently, especially when we look at a monthly time frame with a correlation of, 1 year, 12 months. And you can see here, we're up at almost a perfect correlation, okay? 0.97 when I reported this. Now, the only times that this has happened prior was in 1999, going into the dot-com bubble bursting phase, and then also right here at the height of the great financial crisis before everything came apart. So what does this mean? Well, let's first off look at an updated chart here. You can see that the correlation is coming off slightly here, and you can see it's still highly correlated between the two. So we haven't really seen a big change in correlation yet. However, if this starts coming back down and the correlation starts changing, it's going to be something worth paying attention to. Now, if we look at individual areas of these, like for example, you can see energy, which is a huge component of the CRB index, is up 41% for year to date. And then right below that is utilities. These are the only two sectors that are actually up. You have a very defensive sector, and then you have a sector that has been technically getting a lot more volatility and kind of coming off a little bit. So it's going to be an interesting to watch there. If you take a look at oil's been in this massive, more of a distribution type pattern. It's been going sideways, but you can see we had this blow off top right here. That was during the Russian-Ukraine news. And then ever since then, we haven't actually reached to that peak. And now we're struggling to hold that 200-day moving average. We just had our first daily close below it we haven't seen a daily close below the 200-day really since, I guess, back here in before the year, right? This is the first time of the year that we've closed below the 200-day moving average. That was in December of 2021 over here. So if this continues to fall, we could look at potentially 85 here. Now, if oil falls, that means that commodities will also, the CRB index will most likely come down too. And as we've already stated, when commodities start to fall and bonds potentially start outperforming, well, guess what? Defensive sectors typically work pretty well. So if we take a look at bonds, we'll take a look at TLT. The TLT has been basing out and it's breaking the neckline of this inverse head and shoulder pattern. But it's nothing to get like overly too excited right in this very moment at this particular point in time, and I'll explain why, because there still could be very well of a base building. And also I look at weekly expected moves. So you don't want to buy when you get these strong moves here. You want to be able to, position yourself tactically. But looking at all this data, how do you kind of navigate this recession? Especially if we go into a deeper recession, where things can get just obviously very tough for the overall markets. It's very simple. Right now, what you would be looking at is short commodities, you'd go long bonds, and you would go long utilities. So why? Well, we just explained it right here. Commodities versus bonds. Once this starts coming down, utilities, defensive sectors will outperform the S&P 500. Doesn't mean that they both can't go down, because if a VIX goes, into the 30s, utilities can get hit too, but is typically going to still outperform the S&P 500. So utilities is going to be something to watch if this correlation obviously starts breaking down. And what we're seeing now from an absolute basis is we are seeing commodities take a little bit of a back seat, and we're seeing bonds start to base and get stronger. So if bonds start to move up or continue to base as commodities fall, this line is going to start falling, which can perpetuate this line up higher, which tells us what? It tells us exactly what we just mentioned just a moment ago, which is you can look for potentially finding shorts in commodities, various commodities. Doesn't need to just be energy or oil. You can look to go long bonds, and there's TLT, there's shorter term bonds like SHY, municipal bond. There's all different types of bonds, right? And then also you can look into potentially long various utilities too, or utility equities. If I keep moving on, the reason why I brought up TLT is like, hey, you might not want to jump into it right away, is because already week to date on the very first trading day of the week, we're already at that weekly upper expected move. Okay, so it could very well, consolidate more. It could rip higher, who knows, right? But it is going to be something to continue to watch and buy, as we see pullbacks, and then, position yourself a little bit better from a risk to reward standpoint. Jumping in, as soon as it had a up day of 2.41%, it would kind of suck to jump in right here and all of a sudden it pull back to a 50-day or 20-day moving average back to 116, and you kind of got to hold throughout that. Okay, so continue to watch that and see how it develops. If we take a look at XLU has also been on a very strong move to the upside, so it's getting a little extended here. Not exactly the area where I would just be hopping in, blindedly. I want to see how it consolidates, how it sets up, and then I'd start looking for individual utility stocks or the sector as itself. So if we continue on down this path, another very important aspect to watch going into this recession of 2022 is the dollar. The dollar has been very bullish in 2022. It's been one of the best performing assets of 2022. And you can see here, there's been multiple times where we've consolidated, broke out, consolidated, broke out, consolidated, broke out, consolidated. Are we going to break out here? Well, it's to be determined at this particular point in time. Okay, so you can see, and these little patterns right here, if you don't understand these, it's totally fine. But all it is periods of expansion to contraction, expansion, contraction, expansion, contraction, expansion, contraction. Contraction leads to expansion. So we're going to see potentially a move here soon in the dollar. It's been taking a little bit of a backseat. It's floating right around that 105, which is prior area of resistance, and now could become a potential prior area of support as it's at that lower Bollinger Band. Now, why am I pointing out the dollar? I'm not just looking at it from an absolute perspective, looking at the candlesticks. I'm looking at the dollar because it's a very important asset to look at versus correlations to other assets. So as you can see right here, you can see as this has been falling, the dollar, look at what the S&P 500 has been doing. It's been, going up. And as the dollar was rising, look at what the S&P 500 did. It fell. Okay, and you can see that more clearly here looking at a correlation chart where we go short term to long term down the list. You got 15, 30, 90, 120, 180. Those are days. Okay, and as you can see here, we have a minus 0.93, so a very negative correlation, meaning that if the dollar goes up, it's highly likely in the short term to see the S&P 500 go down. So S&P 500 could very well take a back seat if the dollar finds its footing. I don't know the word footing. I don't know. Its stance. If you take a look here at more like 90-day, 120, and 180, you can also see very negative correlations in the longer term. So it's very important to keep an eye on the dollar and those correlations as they continue. If you take a look at oil's there's not much in the short term as far as 15 days goes of a correlation. It's pretty flat. All right, so it is what it is. But if you just take a look out 30 days, you're looking at a minus 0.74 correlation. So if the dollar continues to perpetuate up, that could very well crack oil to go further to the downside, okay? Which means if the dollar continues to rise, commodities can still be very well a good short, or even countries that are, heavily based in commodities. So for example, you can look at Brazil, you can look at, I guess, just various other currencies too as well. For example, like the euro, right? That's obviously that's a negative correlation. If we take a look at gold as well, you have a minus 0.67 on the short end there of a correlation. So if the dollar continues to rise, gold could take a little bit of a backseat or consolidation, right? And you can see here it's a negative 9.92 reading on a 30-day, 0.93 for 90-day, and then you have 0.76 for 120, 0.26 negative on 180. So it's a fairly negative correlation. So if the dollar continues to rise or move at a rapid rate to the upside, it could very well knock gold back down as well. So this is going to be one to watch and see how it works. The gold has been holding up fairly well year to date, despite the rise of a dollar. So, if you just look back here to 2022, the start of it, you look back to the side of the screen, gold is relatively flat. So despite, the negative correlation, gold is still actually a fairly strong performing asset year to date versus these other various areas. Okay, so as we've stated, make sure to keep an eye on the dollar. You got to look to various commodities, because if the dollar continues to perpetuate up, or if bonds start to outperform commodities, that does make for a good kind of a pair trade there, where you can look to short commodities, look to go long on bonds, and then also long utilities. If we continue on kind of down this path, let's look at some more charts here. We're looking at the monthly time frame. I want to just give you some insight here. We're still right around that monthly 5 EMA. The quarterly move right here is expected to get to around 4,300 to the upside, 3,400 to the downside. Those are the dashed lines. The solid line is a monthly expected move. This is moves calculated by implied volatility. So it's plus or minus, and it gives us a range, and 68% of the time it'll land within the range. So you have right here 4,300 just above that for the upside for the month, and then for the downside it's around 3,900. That's month to date there for the S&P 500. We are out of that 20% from peak to trough here. We're out of that bear market, which is the red shaded area, okay? But as it stands right now, we're still below a quarterly 5 EMA, and we're still kind of fluttering right around the monthly 5 EMA. So as it stands right now, it's very, very neutral from that perspective. If you look at the Qs, we are still in bear market territory. You can see that we hit the quarterly expected move and found a little bit of resistance. We'll see if that comes up, because the monthly expected move takes us to just under 340 to as low as about 295. And you can see we're also fluttering right around here on the monthly 5 EMA there too as well. And if you pay attention to the RSI is slightly above 50, but it is kind of going sideways, and you have wind at your face if you're looking at that PPO. The same goes here for the RSI on the S&P 500. It's relatively flat, just above 50, and you have wind at your face right here too as well. So we'll see kind of how that plays out. If you look at the IWM, it's right there fluttering around that monthly 5 EMA there too as well. Remember, this is the most frequently tagged EMA, and you can see here all the candles did it. So are you surprised that when we close way down here, we got to reconnect? I'm not. That's kind of to be expected for the most part, as we've seen that happen multiple times. Now, from the upside perspective, the quarterly expected move is just above 190. The monthly expected move is just below 200. And then also right here about 175 on the low end. And then if we get some massive volatility, right, the quarterly move on the downside is around 149. All right, now let's hop into the weekly expected moves and then the smaller time charts too, and then we'll get into some indicators just to give you an idea kind of where everything's at. If you take a look at the weekly expected move right here, it's about 420 to the upside, 404 to the downside, and we're really just flat. We had a small down day today, minus 0.3%, albeit it was very volatile. And you can see here, this move to the upside has been very aggressive, coming into prior areas of chop. So it could hang out here again. We could potentially see it break these levels, but as it stands right now, we have all this to get through, which is, going to be difficult, I would imagine, for the most part. And then right above that is a weekly expected move. This is very similar to the March rally over here, where we kind of cracked above those highs and then it started falling off. So perhaps we do crack above those highs right to that 420 level, and then we can start potentially digesting this move, or it might continue this volatile chop back and forth. If we take a look at the 30-minute time frame, I use a 30-minute time frame instead of a 15, and I reduce the moving average to 65. So that's a 5-day moving average there. The reason why is so I can see the upside and the downside of the range. On the shorter term perspective, using this 30-minute time frame, we are still above an inclining 5-day moving average. So it's still in the bull's favor at this particular point in time. It will continue to be until we start seeing price below it and this start curling back over. So the short-term bias still remains to be to the upside. If you take a look at the volume profile, you can see in the last 3 months, there is a lot of volume here. So this is why another reason it could get, caught up in this area, which we kind of saw today, getting caught up in that area. So if it starts taking a back seat, understand the 5-day moving average is moving up. So if it hits the lower end, this could act as a potential area of support to be aware of moving forward, especially on the short term. Now, if we take a look at the Qs also down slightly on the day, relatively flat overall. We have a weekly expected move to above 3, or just about 325 to the downside, around 306. And this is very similar to what we saw take place here on that March big bear market rally, where it kind of cracked this high right here, which we're seeing right here, cracked that high. But overall, it's still within this kind of channel that we're seeing, right? This little up channel where we're seeing shorter term, higher highs, higher lows. And we just cracked this one, which is a big one. Now it's important to see if we can hold that as these moving averages start to continue to curl over, and see if actually this could be some sort of rounding type bottom. Now, given all the stuff that I've told you already, people can get very, very bearish, but understand markets have rallied in times of this kind of bearish narrative too as well. So that's why it's always important to pay attention to the shorter time frame. And not to just and not to ignore that, right? I'm seeing a lot of good setups overall from the long perspective. I'd like to see more, but when you look at these shorter term perspectives, just pay attention to that 5-day moving average. Is it pointing up? Is it pointing down? Is price above it, or is price below it? And as it stands right now, price is above an inclining 5-day moving average. So the bias in the short term still remains to be bullish, given this current context. Now, if we take a look at the IWM before we get into some indicators, we're looking at about 192 to the upside, which would come into an area of resistance, prior support, so that could be a hard area to get through to as well, and about 182 to the downside for the weekly expected move. Understand that these expected moves, you typically finish 68% of the time within it, but the last 2 weeks in the S&P 500, I believe in the Qs too, and the IWM, we finished outside of the weekly expected moves, which is a pretty rare occurrence, and it's very unlikely to see that happen for 3 weeks in a row. So continue to watch that. Now, I do find it interesting that volatility subsided a little bit, given how much swings back and forth we had. So even though we might have a small range, I still expect to see quite a bit of volatility in this environment. If you took a look at the 30-minute time frame, we are above that 5-day moving average, and it is inclining. It's getting a little steep here, right? Last time we saw a very steep one, it did curl over and we got hit hard. That was in that kind of May to June rally right there. So we'll continue to see how that develops. But from a shorter term perspective, we're coming up into prior areas of resistance right about 190. Could get caught up there, but we are still above a inclining 5-day moving average. So what you need to see if you are bearish or want to be bearish, wait for this to start curling over like so, and price to act as resistance to it, so we can then have, I guess from a bearish perspective, more momentum on our side versus, trying to fade the markets, which is still could be very profitable, but you need to be very, very tactical fading the market. Let's hop into some stock market indicators. I'm going to show the BP charts, updates on them. BP Composite getting very high readings, 75.40. Not a place where I'd be going long. I've been scaling into some various shorts. I've been getting out of some of my longs and building up a cash position. I am looking to deploy more cash. I just want to wait for the proper setups, and I'm really not in a rush here. I don't care if the market continues to perpetuate to the upside, because eventually it's going to digest and reset up. It's not about buying at the best price, it's about, or the lowest price. It's about buying at the right price that makes sense from a risk to reward standpoint. So BP Composite, which is the NASDAQ composite, it is getting overextended to the upside. All right, if we take a look at BP NDX, this one is not overextended to the upside, which could give it room to fall further, right? Or potentially move up, so not much there. BP INDU, which is the Dow Jones Industrial Average, it is getting a little frothy over here, getting to 76.07. Okay, there's less equities, obviously, in the Dow Jones, so this could stay elevated for quite some time. But needless to say, we do have a couple companies reporting earnings from the Dow Jones this week. I believe 2 of them are going to be reporting, so we'll see how that plays out. The transport, so BP Tran, this is another one that's been just rocketing higher, and it's going to be, I forgot to change that one out, so that's just the Dow Jones Industrial Average, but transports have been flying sky high, and we haven't seen a reading like this for a little while. It was really the beginning of the year, and now we're at 76.05, so it's getting a little frothy here as many transport stocks have been ripping. BP SPX, we're getting 77.68. We haven't seen a reading like this probably dating back to, late or early 2021, right? That's 2021, maybe around 2020, that area. I have to pull up a chart for that, but that is getting pretty darn frothy, so be careful about that. Energy, also 74.05, getting extended. Financials, it is now 72.62. Just the other day, it was on Friday, almost the high of day, right around there. I added another 50 basis points into my short position, and I actually considered covering that 50 basis points today just to kind of play around my core position. But I ended up not, and I'll just see, I'll see what takes place in these next couple of days. It's not that big of a position, but I, slowly have built into it. Because I feel like financials are going to get hit here at some point. So that's what I'm watching for. This consumer discretionary, the BP disc chart over here, this is not overextended anymore. It is kind of floating around right around 70. It's at 65.52. So that says it can have more room to go up, which we saw some of the stocks go up today. But it also room to obviously fall. Technology also getting pretty extended at 74.76. So monster rally overall. A lot of these BP charts and the big sectors, they're getting overextended. You have a Pring bottom Fisher indicator that's been slowly curling back over, but the market's been perpetuating up. That kind of reminds me of right here, how we curled back over and we started ramping up, and then we saw some move to the downside as it followed through. Right here, obviously, we saw downside. Right here, we saw downside. Right here, we saw downside too as well. This is not a holy grail indicator. I like it for actually finding bottoms, not necessarily looking for tops, but people like to see this, so I'll show it to them. If we take a look at the NASDAQ McClellan oscillator, the last time I believe I showed this was around this bullish divergence right here on this falling wedge. Well, we broke out of that, but I want to call out here that we do have now, we have a high to a higher high in price, where we have a high to a lower high in the oscillator, which does signal a negative divergence that is building. Doesn't mean it's going to play out, but you can see price has just ramped up higher, and this right here could be an early sign of saying to us, hey, the price is moving up higher, but the internals are weakening, so be cautious right here, and then we can pair that with all the other indicators showing some overextended territory. So just be careful, be mindful of that going on right now. This is one of the indicators that we pointed out from a bullish standpoint, which I wanted to just show you, follow through on it. You have a low here to a lower low, a low to a higher low, and this is just SPX over TLT. You can also look for negative divergences, which I'll show you if that builds, but you can see the S&P 500, once we call that out, has been rallying nicely so far there. So we'll see if things change. Another good thing from a bullish perspective is the summation index actually did crack through zero, and we have not seen a reading above zero since basically the very start of 2022. So that is a pretty bullish sign. I will say that the 9-month had a negative divergence building. It broke, but it is at a somewhat extended reading as far as a level goes. Okay, above 250, it's a little frothy. So I could very well, as if all these indicators start backing off or price digest, this can start turning over here in the very near future. Another thing that I want to call out is the Saylor to Schiff indicator today just made a big U-turn over here, heading to around the just below 10% rate of change. So it still has a while to go to fall through zero. The last time it signaled below zero, we saw that big, huge drop in the price of Bitcoin. Another thing that I want to call out here, though, one of my patrons brought this to my attention, and I've been seeing it, but I never got to make a chart until they brought it up. And that is just how, similar it looks to the NASDAQ composite. So growth stocks, right? Bitcoin is like a higher beta version of growth stocks. And if you look here, it's not exactly the same, but I just overlaid composite instead of Bitcoin. Well, the buy signal was right here and we're starting to rally. The sell signal was right here and we started to fall, right? And we had a buy signal, we had a sell signal, we had a sell signal, right? Buy signal. So it actually works quite well. So if this starts crossing down through zero and we get an actually a validated sell signal, this week, next week, whatever the case is, that could be a very big sign for us that many people aren't going to be paying attention to, because not too many people have actually put in the work to understand this indicator. And if you want to watch this indicator, how I build it, I have links in the description. I called it the Saylor to Schiff tool. If you take a look at Bitcoin continues to just, put in some higher lows, higher highs, just perpetuating up right here. Could be a rising wedge structure. Remember, this right here was when the sell signal activated, okay? And then we saw that big sell-off. Actually, I think it was actually before then. Let me actually check, when was that? So that's just in the middle of June. Yeah, it was, the last sell signal was actually in April. So let me go back over here. April was right. Yeah, right. Yeah. April was right here. So then it caught this move to the downside. However, this is wedging at this particular point in time. It could be potentially rounding, base, but if we get a sell signal, be very, very cautious of that, because it could very well break this wedge structure and we could see something very similar to what we saw here and or that we saw here, indicating some more further downside in the price of Bitcoin and potentially other various cryptos or crypto equities. All right, everybody. That's all I got for you. Today was a big episode, a lot of information. Hoped it helped out. If you have questions, leave them in the comment section below, and I'll try to do my best to get to them. Have a